Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. Oil prices were boosted this week by the loss of 4 to 5 million barrels of oil production per day when severe winter storms caused statewide power outages in Texas. The storms, reminiscent of the movie The Day After Tomorrow, halted oil and gas production as well as port activity. It is estimated that around 20 million barrels worth of production will be lost before infrastructure will come back online. Globally, 111 million people have now been infected with COVID-19 and over 2.5 million people have succumbed to the disease. The United States remains the hardest hit with more than 29 million infections and 505,000 deaths. Brazil, India, the UK and Russia make up the top 5, and South Africa has thankfully moved down from 15th to 16th position in terms of most cases recorded. New coronavirus infections are sharply lower in most hard-hit countries, most strikingly in the United States. Vaccination programs are also starting to gather momentum, with the US leading the way with nearly 60 million doses administered. China has thus far vaccinated over 40 million of its people and the EU 25 million. Israel has the highest rate of vaccination, with 80% of its citizens having received the jab. Worldwide, 195 million people have now been vaccinated. As was expected, flattening the infection curve has resulted in a dramatic reduction in the number of COVID-19 deaths. In the United States, fatalities have now dropped below 2,000 per day, a reduction of nearly 50% compared to a month ago. Germany is the only major country where daily deaths increased this week. Total daily deaths worldwide have now dropped from over 14,000 to below 10,000 over the past month. The latest IMF forecast predicts global GDP growth of 5.5% this year, with emerging markets contributing the lion's share. Concerns over inflation have caused a spike in US bond yields, even though CPI remains subdued for now. Most of the developed world experienced slower or negative GDP growth in the fourth quarter of 2020, and China has just replaced the US as the Eurozone's largest trading partner. This infographic portrays the International Monetary Fund's current view on global GDP growth over the near term. After contracting by 3.5% last year, the global economy is expected to grow by 5.5% this year and by 4.2% in 2022. Emerging markets are expected to outperform developed markets by 6.3% to 4.3% this year and by 5% to 3.1% next year. India and China are expected to contribute a large chunk of this outperformance. In the United States, consumer price inflation, the dark blue line, was at 1.3% in January, well below the Federal Reserve's target of 2%. It is significant that the dotted line, representing core inflation, which excludes fuel and food prices, is trending sharply down, even as the headline number is creeping up. This means that consumers are still reluctant to spend on non-essential goods and services. These two graphs show a similar pattern, but from a different angle. Expenditure on goods, which includes essentials like food and energy, is represented by the blue line and is trending higher. Expenditure on services like dining out, entertainment, and travel is represented by the green line and is clearly subdued. The MSCI World Index is up strongly for the year to date, and higher US bond yields are giving the dollar a boost. The gold price is down, even as the prices of oil and platinum are rising. Punters are following Elon Musk's lead and piling into Bitcoin, while Warren Buffett has been quietly taking profits from technology and diversifying Berkshire Hathaway's portfolio into communication, financial services, and energy. The JSE Top 40 has been one of the year's standout performers thus far, along with the US Mid-Cap Russell 2000 Index. The technology-heavy Nasdaq has also enjoyed a strong run, but the gap between Wall Street and the rest seems to be closing. Even London's FTSE 100 is well up for the year to date. Skeptics are worried that the current global rally is overdone, but bulls argue that it will be sustained by low real bond yields and improving company earnings. The price of oil has largely recovered from last year's big slump, and Brent crude is flirting with $65 per barrel. There may well be considerable upside left, given that global trade and travel are likely to recover sharply later this year. While this may be good news for oil producers, it could cause inflation to rise in net importer countries like South Africa. With the exception of oil and platinum, most commodity prices have sagged under the weight of the resurgent dollar. Except for oil, most commodities are, however, still trading well above their levels of a year ago. Among offshore asset classes, we prefer equities. Firstly, because their dividend yields are superior to the interest yields of bonds and cash, and secondly, because the imminent recovery of the global economy should result in improved earnings and lift share prices. We see the biggest potential in emerging markets, while other developed markets should start catching up to the United States. Listed property faces both opportunities and threats, but we believe valuations are fair and dividend yields are attractive. Bond and cash yields are lower than inflation in most developed markets, and will stay that way as long as central banks continue to stimulate growth through low interest rates and inflating the money supply. In the government bond space, we prefer emerging market bonds, and where we are mandated to invest only in developed markets, we prefer high-yielding bonds to gilts. Here at home, the latest skirmish in the ongoing war between President Ramaphosa's centrist faction of the ANC and the so-called Radical Economic Transformation faction of former President Zuma involves Zuma's refusal to testify before the State Capture Commission. Commission Chair Raymond Zondo wants Zuma prosecuted for contempt, and in response, MK veterans under Kebi Mapatswe and Carl Niehaus are camping out at Nkandla and vowing to defend Zuma against what they call his persecutors. As of last night, 1.5 million South Africans have tested positive for COVID-19 and nearly 49,000 have succumbed to the disease. Yesterday saw another 230 deaths, while 2,327 new cases were diagnosed. In both instances, the numbers are well down on those of a month ago. The Eastern Cape has suffered the most deaths to date, while KZN has by far the most active cases at the moment. South Africa has offered its AstraZeneca vaccines to the African Union and replaced it with the more locally effective Johnson & Johnson product. CPI edged up in January, and motorists are bracing for higher fuel prices. Electricity prices are set to rise at 4 times the rate of inflation, and Discovery's Adrian Gore estimates that half of the population has already had COVID-19. The ANC's leadership is meanwhile set to meet with former President Zuma to try and convince him to respect the commission he himself instituted. Good news in the run-up to next week's budget speech is that tax revenue has exceeded the expectations expressed in the medium-term budget policy statement in September. Corporate tax receipts, the brown line, have been boosted by booming mining and agricultural exports, and VAT receipts, the blue line, have recovered nicely since the relaxation of the lockdown. Personal income tax revenue remains weak, however, largely due to job losses and immigration. The Treasury is under immense pressure to find ways of raising additional revenue. While there is much talk about taxing the rich more heavily, economists warn that tax rates are also subject to the law of diminishing returns. The so-called Laffer Curve demonstrates that tax rates reach a point where further increases actually result in revenue declining because people stop investing, evade taxes, and even emigrate. Less than 14% of South Africans pay income tax because wealth and income are so unequally distributed. This has resulted in very high personal income tax rates with a yield equivalent to 10% of GDP. Because VAT is regressive and politically sensitive, indirect taxes bring in only about 8% of GDP. Company taxes contribute less than 4% of GDP, but raising them would harm investment and job creation. The JSE is benefiting from positive sentiment towards emerging markets in general, but bond yields are starting to rise. Telkom is gaining ground in the mobile telephony space, while COVID has hit Momentum's earnings hard. The Rand has had a volatile week on forex markets, and Checkers had a strong half year. This week, Ivan Glasenberg announced that he would be stepping down as Glencore CEO after 18 years at the helm. Thanks to attractive real yields, South African bonds remain popular with foreign investors. Last week saw a net inflow of R500 million into the bond market from abroad, and for the year to date we attracted well over R10 billion. After a weekly net outflow of nearly R2 billion from the JSE, the equity market is now in the red to the tune of R1.3 billion for the year to date. The Rand has been steadily strengthening against the US dollar since May last year, making it one of the best performing emerging market currencies versus the greenback. This happened while the dollar was weighed down by US fiscal and monetary policy, and time will tell whether the Rand will be able to stand its ground as rising American bond yields start to lift the dollar. On the domestic front, we have increased our tactical allocation to equities from underweight to just below neutral. We remain cognizant of South Africa's socio-economic challenges and policy follies, but given the favorable global backdrop and undemanding valuations, we are beginning to see opportunities among local shares. Government bonds remain our preferred local asset class. We are aware of the risks to the fiscal outlook, but South African bond prices have, in our view, already factored in a substantial risk premium. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak Rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.